Imagine waking up every day, working hard, and unknowingly watching your hard-earned money slip away. Not because you're spending it recklessly, but because it's quietly losing its worth. You might not even notice it happening. It's not theft in the usual sense. It's a slow, hidden process that makes every dollar in your pocket buy less over time. Year after year, your paycheck stretches thinner while costs for everyday things like food, housing, gas, and schooling keep climbing. You push yourself harder, but prices outpace your earnings. This isn't just bad luck, it's called inflation. But what if this isn't a random economic glitch? What if it's actually part of the plan, a built-in feature of the system designed to keep things running this way? The truth is uncomfortable. This setup has been in place for over 100 years. Stay with me through this video, and by the end, you'll understand why inflation isn't a mistake. It's the core of a financial engine that makes sure you never truly get ahead. Inflation might seem like a natural force, like weather that just happens without anyone controlling it. But that's not true. It's a deliberate policy, created and managed by central banks. Think about it. If prices keep rising while your pay stays flat, someone is coming out on top. That someone is usually the government and the big financial players who get the new money first. When fresh cash enters the economy, it doesn't go straight to you. Instead, it flows through bond markets, banks, and asset prices. By the time it trickles down to everyday people, costs have already jumped. You're left spending with money that's been watered down in value. This whole design goes back to a key moment in 1913, when the Federal Reserve was created in the United States. Its original goal was to steady the economy, but over time, its real role became clear: to keep debt growing endlessly. In our system, every dollar starts as debt. That's not just a figure of speech. Money is actually made when someone borrows it. Whether it's you taking a loan, a company issuing bonds, or the government spending more than it collects in taxes, that's how new dollars come into being. To keep the economy growing, debt has to grow too. And to make that debt feel manageable, you need inflation. Why? Because it slowly reduces the real value of old debts. Governments love this because it lets them pay back what they owe with dollars that are worth less. You might ask, if inflation hurts so much, why not just stop it? The answer is simple. Stopping it would cut off easy borrowing, which could crash the value of things like your home, stocks, or savings, all priced in inflated money. That's why central banks aim for about 2% inflation each year. It sounds harmless, right? But at that rate, your money loses half its buying power in around 35 years. A $10,000 savings today will only buy what $5,000 could when you retire. This isn't an accident. It's intentional design. Let's break it down with real numbers to make it clear. Suppose you save $100,000 in a bank account earning just 1% interest, while inflation runs at 3%. Each year, you lose about 2% of your purchasing power. After 10 years, your savings are worth nearly 20% less in real terms. Meanwhile, banks use your money to lend at higher rates, and the government taxes the small interest you earn, while ignoring the inflation that eats away at your savings. So, you're actually penalized for being a responsible saver. Inflation rewards those who borrow and punishes those who save. It nudges you to spend or invest more, keeping the debt-fueled system spinning. Who really wins in this arrangement? The people closest to the source of new money, the ones who get it first. When governments sell new bonds and central banks buy them with freshly printed cash, that money goes to financial institutions first. They invest early, snapping up assets like stocks, real estate, and commodities, which all rise in price with inflation. By the time this money reaches wages, its value has already dropped. This is known as the Cantillon Effect, named after an economist from the 1700s who spotted how new money helps the wealthy first. Inflation isn't fair or equal. It's uneven. It boosts a small group at the top while chipping away at everyone else's income. History shows this pattern repeating. Ancient Rome weakened its silver coins by mixing in cheaper metals. France printed money recklessly until bread became unaffordable. In the 1920s, Weimar Germany saw prices soar wildly. Zimbabwe and Venezuela faced similar chaos in recent times. Each case started with economic stimulus and ended in disaster. You might think wealthy nations like the US are safe, but look closer. In 1971, when President Nixon cut the dollar's link to gold, it lost its last real anchor. Since then, the dollar's buying power has dropped over 85%. Costs for homes, college, and healthcare have exploded, while wages have barely doubled. This isn't real progress. It's a subtle shift of wealth from you to others. Every paycheck you earn feeds this slow drain. Governments claim inflation means economic growth, but whose growth? When central banks boost demand, they drive up prices for basics like rent and groceries, while things like electronics get cheaper. Then they say inflation is under control. But that's misleading. It's the trick of averages. The Consumer Price Index (CPI), which measures inflation, is manipulated with substitutions. If steak is too pricey, they assume you'll switch to chicken. That's not true stability, it's just making do. Inflation forces you to accept less and call it normal. And then they tell you to invest to beat it. Another trap. The stock market swells from the same money printing that causes inflation. When interest rates go up to fight it, asset prices drop. You're chasing a moving target, and the system always comes out ahead. Meanwhile, governments, big companies, and banks collect interest and fees. The longer this goes on, the wider the gap between rich and poor grows. Inflation acts like a tax you never voted for. Silent, ongoing, and compounding. So what if inflation stopped and prices fell instead? That's deflation, and it would make debts feel heavier, leading to more defaults and economic collapse. That's why central banks dread deflation more than anything. They'll keep printing money forever to avoid it. Controlling the money supply lets them control wages, housing, savings, and even politics. Inflation isn't just an economic tool. It's a way to shape society. It keeps the economy hooked on debt. Every government budget, corporate loan, and home mortgage relies on it. Without rising prices, debts become too heavy to bear. Leaders can't afford to stop it. When they talk about price stability, they mean controlled decline. You lose value slowly so you don't notice. Most people don't question it. They think it's natural, like gravity. But once you see it, you realize every dollar is a claim on future work. When those claims grow faster than goods and services, it's like theft through dilution. Subtle, legal, and nonstop. Take housing as an example. In the 1970s, a typical US home cost about 3 times a family's yearly income. Today, it's 7 or 8 times. The houses haven't changed much. The money has. Each new dollar printed pushes prices up. Inflation lifts asset values first, making those who already own them richer on paper. Those who don't own assets fall further behind. It's not better productivity driving this. It's just more money in circulation. This fake prosperity hides a transfer of wealth from future generations to the present. Governments depend on it, funding extra spending with borrowed money and then shrinking old debts via inflation. It's an old trick, used especially after wars. After World War II, US inflation wiped out nearly half the real value of government debt. The same happens everywhere. The big losers? Anyone holding cash, bonds, pensions, or savings. Their value erodes while leaders brag about growth. They say mild inflation spurs investment, but really, it fuels risky bets. People chase assets like art, land, or cryptocurrencies not for their usefulness, but because they seem safe from money dilution. Bubbles build, pop, and rebuild. Each cycle moves wealth from newcomers to insiders. Financial news calls it market dynamics, but it's really policy-driven manipulation. Central banks inject cash, markets boom, insiders cash out, and then they pretend to fight the inflation they created. When rates rise, regular people lose jobs, but the wealthy have already moved their profits elsewhere. Now, look at wages. Leaders boast about raises, but real buying power often drops. Over the last 20 years, pay has gone up about 60%, but living costs have risen 90%. That's a hidden pay cut. Workers run faster on a treadmill that speeds up yearly. Inflation breaks the connection between hard work and fair rewards. Labor turns into a product priced by policy, not by how productive you are. The urge to save disappears. People borrow for school, homes, and healthcare. Debt becomes part of who you are. You don't own your life. You rent it from lenders. Ironically, most trust the very groups causing their struggles. Central bankers use calm, technical talk, promising smooth outcomes and data-based decisions. But their true job is to protect the financial setup, not your savings. Every interest rate change is meant to direct credit flow. Inflation targets are just an excuse to steer the whole economy. It's a controlled system pretending to be a free market. After the 2008 financial crisis, central banks printed trillions to buy government bonds and home loans. They claimed it would aid recovery, but it mainly puffed up asset values. Stocks tripled, fancy properties skyrocketed, but wages stayed flat. By 2020, the top 1% owned more than half the world's wealth. Not from brilliance, but from being near the new money. Then the pandemic hit, and even more cash poured in, creating a brief sense of fairness. But inflation soon clawed it back. Prices shot up, savings vanished, and inequality grew again. This system survives on short memories. Each new generation inherits a weaker currency and thinks it's fine. Your grandparents might have bought homes with one income. Your parents needed two. You might need lifelong debt. Inflation shifts what we expect quietly. Things that were affordable become luxuries. Governments point to GDP growth as success. But GDP tracks spending, not happiness. Inflation inflates GDP too. It's a numbers game that masks stagnation with bigger figures. Ask yourself, why do they fight deflation so hard? Because it helps savers and hurts borrowers, flipping the power balance. When prices drop, money's buying power rises. Governments would have to raise taxes or cut spending instead of printing. Companies would need real efficiency to profit. The debt pyramid would topple. That's why they treat even mild deflation as a disaster. They prefer endless inflation, a cycle of steady loss that forces constant economic activity, no matter the cost. Some say mild inflation drives creativity, but innovation flourished in stable or falling price eras, like the late 1800s. When money keeps its value, businesses compete on quality and smarts, not wild bets. Inflation messes up signals, making it hard to tell if rising prices come from real shortages, demand, or just more money. This confusion leads to bad choices. Whole industries boom and bust not on merit, but on money waves. You might wonder if there's a way out. Gold used to provide stability, but it was ditched in 1971. Cryptocurrencies try to bring back scarcity through code, but they're still tied to risky markets. True stability needs discipline. Government spending only what they can afford, central banks stepping in only for real emergencies. That discipline vanished a century ago. Now, every problem gets solved by printing, planting seeds for the next bubble. Inflation builds up over time. Once people expect it, reversing it is almost impossible without pain. Think about the divide between generations. Older folks who bought assets long ago gain from inflation. Their homes and investments rise in name only. Younger workers face higher starting costs. They rent longer, save less, and borrow more. This breeds frustration and division. Inflation doesn't just weaken money. It weakens trust. People lose faith in fairness, institutions, and each other. When prices beat wages, society fractures. History shows lasting inflation often sparks unrest. It's a quiet spark for uprisings. This decade mirrors the 1970s. Supply issues, bigger deficits, political stalemates. Back then, inflation hit 14%. Today's official numbers are lower, but real inflation, including housing, food, and education, feels worse. Central banks say it's short-term. They'll hike rates, slow things down, and claim victory. But prices will settle at a higher level, meaning you pay more for everything, and they'll call it a win. That's the deception. Inflation never fully reverses. It just resets the starting line. Each reset moves wealth up. Asset owners surf the wave. Paycheck to paycheck folks sink slowly. Media labels it a cost of living crisis, but it's not a crisis. It's policy. Inflation isn't from mistakes. It's the base of modern finance. Without it, the debt pile collapses. Money designers know this. They speak of fairness, but their system needs losers. You're meant to work, spend, and owe endlessly. Inflation's trick is its invisibility. You don't see your dollar shrink. You just see prices rise. By focusing on products, not money, the system hides who's to blame. Every government blames outside shocks, but the root is too much borrowing chasing too few real goods. Until that changes, your money will keep losing value, all while they call it stability. So, where does this all lead? Picture a fork in the road. One path keeps the cycle of debt, inflation, and fading value. The other requires facing the truth. Most choose the first. It's easier to believe the illusion. You see your pay go up, your home's value rise, your investments climb, and you feel richer. But the harsh reality? If everything you own is valued in a currency that's shrinking, your wealth is just treading water. It's like climbing an escalator that rolls down faster than you can go up. This isn't a secret plot. It's built-in design. Inflation is a feature of today's money, crafted to make people keep borrowing, spending, and driving growth, regardless of the toll. Politicians like it for cheaper debt repayment. Central bankers defend it for system stability. Companies profit by hiking prices and reporting big gains. But what about you? The saver, the worker, the dreamer? You get the fake choice, not real control. Let's trace it to the root. Fiat money. When currencies were backed by gold or something scarce, printing was limited by reality. You can't make gold from nothing. But after 1971, when the US untied the dollar from gold, money became just an idea, a promise, not real value. Governments learned they could spend freely, and central banks mastered controlling economies with rates and digital printing. Now, Every dollar, euro, or yen is a bet on trust. When trust slips, the illusion shakes. History shows every major fiat currency eventually fails. Rome's denarius, France's assignat, Weimar Germany's mark, all collapsed when printing outran production. The timeline differs, but the end is the same. Faith vanishes, and people grab real things like gold, land, food, or foreign cash. Inflation doesn't destroy value right away. It eats at it slowly, then fast. The end comes when belief shatters. And here's the eerie part. Inflation is hidden, but hyperinflation is obvious. When prices double every few days, people stop counting. In Weimar Germany, pay was handed out twice daily because morning wages couldn't buy bread by evening. In Zimbabwe, trillion-dollar bills became worthless overnight. In Venezuela, savings evaporated before payday. In each case, leaders blamed greedy sellers, foreign traders, or supply problems. Never their own printing. You might think this can't happen in advanced economies, but collapse starts with denial. In 2008, trillions were printed to save the system. In 2020, more for stimulus. Each rescue made the extreme seem normal. Today, central banks sway markets with a single word, and whole generations can't afford basics. Inflation might not be hyper yet, but it's built into our financial makeup. There's a saying, if you owe the bank $1 million, it's your issue. If you owe $1 trillion, it's theirs. Governments worldwide owe hundreds of trillions. Inflation is their getaway, a quiet tax on savers letting them repay with cheaper money. You work harder, save wisely, and lose without a fuss. It's the smoothest robbery in history, and most victims never catch on. But awareness brings power. Once you see your currency is meant to decline, you can change your approach. Past savers hid cash under beds. Future ones need smarter moves. Invest in real assets like land, goods, or productive businesses that create tangible value. Knowledge is a currency inflation can't erode. If you know the rules, you can play instead of being played. Still, we must ask, can this system last forever? It depends on trust. As long as people believe their money holds value, it works. When inflation wears down living standards too far, folks seek options. Cryptocurrencies arose from this doubt, offering clear records but with wild swings. Gold endures as the classic backup, yet neither fixes the lack of self-control. True change needs limits, which our leaders have abandoned. In a sense, inflation is the language of power. The British Empire grew via credit, the American one via the dollar. Each superpower used its currency for influence. But every empire that weakens its money eventually fades. When Rome diluted its coins, it lost not just metal, but trust. Inflation erodes not just wallets, but global orders. And the cracks are showing. Rising debts, fading trust, widening gaps.
So what happens when people finally spot the game? Some panic, some adapt, a few profit. Those who control credit, lenders, asset owners, policymakers, always stay ahead. But the rest can take back power through understanding. Inflation hides in plain view, but insight uncovers it. Next time you hear about booming GDP, stock highs, or wage boosts, ask, in what currency? If everything is measured in a shrinking unit, are you truly better off or just distracted? At heart, inflation isn't just economic. It's moral. It favors spending over saving, bets over work, and tricks over truth. It teaches societies to chase quick wins over lasting security. A culture that forgets real value soon forgets trust. And when trust crumbles, no printing can fix it. If you've stuck with me this far, consider this. Every empire, every currency, every age thought it was unique. They said, this time, we've got it under control. But money, like truth, can't be twisted forever. You can mask its decay with clever words, statistical tricks, and policy jargon until one day the illusion cracks. When that day comes, history will not remember the excuses. It will remember who saw through them. But you don't have to wait for that day. Right now, you can start seeing through the fog. By learning about how money really works, how inflation isn't just a number on a chart but a force shaping your life, you gain the upper hand. Protect yourself by focusing on real wealth. Things that hold value no matter what, like skills, relationships, and assets that produce income or goods. Diversify beyond just cash or stocks. Consider owning productive land, useful tools, or even starting a side business that creates real value. And remember, knowledge is your best shield. Share this with others. Spread awareness so more people wake up to the game. In the end, the system relies on your belief in it.
Once enough of us question it, real change becomes possible. Stay informed, stay smart, and take control of your financial future. Thanks for watching. Now go out there and build something that lasts.